Well, there you have it, folks. We bomb Iran, and a week later, S&P 500 and Nasdaq are printing new all-time highs. Momentum picked up this week with tech leading the charge, semiconductors staying strong, and volatility relatively tame. Meanwhile, I was over here getting torched by NVIDIA for the second week in a row. At this point, it's practically a tradition. At the same time, there are a few underlying dynamics starting to shift that are worth keeping on the radar. In this recap, we'll walk through what's really driving price action, how liquidity is shaping behavior, and what the latest data says about the economy and why some insiders might be quietly shifting their position. Let's get into it. This week's rally was led by tech, particularly semiconductors. S&P 500 and Nasdaq pushed to new all-time highs while VIX remained relatively soft. Institutional flows backed the move. Tech saw over $4.4 billion in inflows last week, the highest since June 2024. Of that, $3 billion came from institutional accounts. Notably, a significant portion of this rotation was concentrated. The semiconductor sector now makes up over 12% of S&P 500, and NVDA alone makes up over 56% of that slice. Let that sink in. The S&P's top 10 holdings now account for 38% of the index's market cap, surpassing the dot-com era peak. Passive flows are amplifying that concentration. This can help lift the market in the short term, but it also means that if a few top-performing stocks lose momentum, the broader index could be more vulnerable to pullbacks. On the macro side, the data continues to show mixed signals. Q1 GDP was revised down to negative 0.5%. and personal consumption slowed down to 0.5%. This is the weakest pace since early 2020. That doesn't necessarily indicate a recession, but it does confirm a cooling in economic momentum. Labor data added to that picture. Permanent job losses rose to 1.92 million. Unemployment claims climbed to 1.945 million, both sitting at post-2021 highs. The Kansas City Fed's Labor Market Conditions Index declined to its lowest level since April 2021. While headline employment prints remain relatively stable, these underlying trends suggest softening that could have implications for both household confidence and spending resilience heading into Q3. On the inflation front, May's PCE data ticked a bit higher. Core came in at 2.7%, and the headline held steady at 2.3%. It's not panic-worthy, but it's definitely not what the Fed wants to see either. Layer that on top of soft GDP and rising jobless claims, and guess what? That brings us back to the theme we've been watching and talking about for months: stagflation. Slowing growth, sticky inflation, and a Fed caught in the middle. It's not an extreme outcome yet, but the signs are stacking up. If this trend continues, we could be entering a period where monetary policy gets even trickier and market reactions become more sensitive to every data point. Speaking of pressure, Powell is now facing renewed scrutiny from President Trump, who's called for aggressive cuts ahead of the election cycle. While the Fed remains independent, this adds a layer of complexity to its communication strategy, especially if macro data continues to show divergence between growth and inflation. We also saw a continuation of the geopolitical narrative from earlier this week, something we've covered in the newsletter. US airstrikes on Iranian nuclear infrastructure reportedly caused only a temporary disruption, setting back the program by months rather than years. While both sides publicly claimed victory, markets interpreted the optics as a short-term de-escalation. As noted in the midweek update, this has allowed some pressure to come off crude and defense names for now. But the structural risk remains in the background, one escalation away from a very different tone in energy and global risk assets. More importantly, what this really highlighted is just how sentiment-driven markets have become. Any headline, positive or negative, seems to flip the tone instantly, like watching a pendulum swing. One moment, it's all risk on. The next, it's just risk off, then back again. Constant motion, no pause for logic. Sentiment is calling the shots right now, and that's why it's so important to stay focused on the bigger picture, not just the day-to-day noise. In Asia, China reported 93% year-over-year decline in rare earth magnet exports to the US. This follows a 45% drop in April. Given China's dominance in rare earth processing, this trend could introduce supply stress across the tech and defense supply chains. Another risk worth flagging is the 90-day pause on new Trump-era tariffs that is about to expire. And don't forget, markets actually rallied when the pause was first announced. It helped ease trade concerns and gave risk assets some breathing room. But now that pause is ending and calm might not last. If new tariffs come back into play, especially on sectors like tech, autos, and agriculture, we could see fresh headwind. And just to pile on, the US also halted trade talks with Canada over its new digital service tax targeting US tech companies. That dispute is escalating fast and could trigger retaliatory measures. Markets might not care until they suddenly do. Liquidity conditions are another thing worth tracking. A chart released this week shows global money supply and the S&P 500 moving in near perfect sync. As of June 28, global liquidity stands near $112.9 trillion, approaching record highs. This correlation helps explain why equity prices remain elevated despite mixed economic data. Liquidity is a critical input in today's market structure. As long as it remains abundant, price strength can persist, even without broad fundamental confirmation. But if liquidity flattens or reverses, markets could adjust quickly. And here's the twist. Even though the markets have been rallying, the US dollar has been quietly sliding. The dollar is down about 10% year to date. So when you translate those S&P 500 gains into real dollar terms, it actually tells a different story. After adjusting for the currency drop, the index is effectively still down around 5% year to date. That's the hidden cost for inflation and currency erosion. Your portfolio might be up on paper, but your purchasing power isn't necessarily following along. At the same time, we're seeing insider behavior that's worth noting. On June 27th, Jeff Bezos sold over 25 million shares of Amazon, valued at $5.4 billion. That's one of the largest sales this year. Maybe he just needed the extra cash to cover his wedding in Venice. I mean, have you seen the wedding cost in Venice? Between gondolas, fireworks, and probably renting half the city, even Bezos had to make a withdrawal. Jokes aside, to be clear, none of these signals alone are bearish, but together they create a backdrop that calls for more selective positioning. There is a strength, absolutely, but also sensitivity. So where does this leave us? We're in a tape where most of the market strength is coming from just a few big names. Economic data shows growth is slowing down. Inflation hasn't gone away, it's still part of the picture. And market gains are being fueled more by available liquidity than fundamentals. Insiders are starting to sell into strength, which is extremely alarming. And a quick note, if you want my full notes, trade setups, and macro cheat sheets before the video even drops, get on the newsletter. It's where I share everything in real time. Alright, let's shift gears and dive into technical setups I'm watching this week. I'll only be covering the key charts, the ones I believe actually matter right now. When it comes to indices, I'm narrowing the focus on S&P 500 and Nasdaq futures since they've been the primary drivers of the recent market action. Starting with the S&P 500 futures. We made new all-time highs this week, mostly driven by a handful of names in tech and semis, like we mentioned earlier in the video. The hourly chart shows a breakout to the upside from a rising wedge pattern, which is the opposite what you would typically expect. Rising wedges usually break down, but like any setup, they're not bulletproof. They carry a high probability, not a guarantee. And this week, that's exactly what we saw, a fake out for anyone leaning short. With the geopolitical tension between Israel and Iran easing, markets had room to rally. But I'm not looking to FOMO into this. I want to see a retest of the 6,157 level. If that holds and we get a bounce, that's when I'll start adding back to bullish exposure. If we lose it, I'll be watching for a pullback to 6,070 and possibly down towards the 6,000 level if that doesn't hold. On the daily, you can see the steep move higher, driven partly by FOMO, partly by options flow, and partly by short covering. Again, I'm not trying to chase this. I want to see a clean retrace, confirm the breakout, then I'll look to get involved again for the long side. That being said, yes, my short-term bearish trades got blown out this week, but the bullish ones more than made up for it. Moving to Nasdaq futures, we can see a similar setup. On the hourly chart, we broke above the rising wedge and have been making new all-time highs. My strategy here is the same as with S&P 500. I want to see a retest of the 22,425 level before I add more to my long positions. If we break below that, then I'll be watching for a move back towards the 20,000 level. On the daily chart, we've got that sharp move to the upside. Keep in mind, the Nasdaq has a heavier tech weighting, so the percentage moves tend to be larger. The MACD is showing bullish momentum, but the RSI is getting close to the overbought territory. Again, I don't want to chase this move. I would rather see a pullback and a solid bounce with confirmation before getting more aggressive. The daily chart of VIX has pulled back since we saw de-escalation in the Middle East, but we're still sitting above 16. I will use this opportunity to build longer dated bearish trades in case we have another spike. Based on the seasonality, which I covered a few videos back, we see spikes in VIX mid-June and early July. Also, looking at the daily chart, you could say we're forming a falling wedge pattern. I think next target to the upside will be the 20-day moving average, which also lines up with the $18 resistance level. Looking at the gold futures, we saw a major sell-off this week. Money flowed out of gold as traders rotated into the rally in equities. On Friday, we closed right on the rising trend line that goes all the way back to the start of 2025. You could also look at this chart and call it a triple top, with the next stop potentially being the 3200 if that trend line breaks. And that would be a big deal. Not once in 2025 have we closed below this level. A break here would be a strong signal of a short-term top in gold. For me though, 3200 is the line in the sand. If we lose that, expect a stronger sell-off to follow. That said, I'm still holding my gold miner call spreads that expire in a few weeks. It's more of a hedge in case we get any escalations or negative headlines. Now, I want to take a look at NVDA. This chart is probably responsible for 60% of my losses over the last 2 weeks. On the daily, it looked like we were in a textbook rising wedge pattern. There was also potential head and shoulders forming on the weekly, which added more conviction to the downside. But of course, that would have been too easy. Instead, NVIDIA exploded higher this week and pushed to new all-time highs. Like we mentioned earlier, NVIDIA is driving nearly half of the S&P 500's rally. The daily MACD is still showing bullish momentum, but the RSI is pushing into overbought territory. At this point, I've been burned by this name too many times. I won't be opening new trades on it for now. I'm going to look for value elsewhere. That's how you avoid revenge trading and blowing up your account. TLT has been grinding higher inside a tight rising channel. We recently got rejected at the upper channel line, which also lines up with the 100-day moving average. There is also a key resistance level just above 88.50. That said, this might just be a consolidation before another leg higher. On the downside, we got support near 87, along with the 20-day moving average, which is currently hugging the lower channel trend line. As long as that support holds, the bias here remains bullish. Finally, let's take a look at the US dollar. On the daily chart, we got rejected again from the upper downward trend line. This trend line has been in effect since the start of 2025. And like I've been saying for weeks in these videos, unless we can retake that level, my bias is still bearish on the US dollar. This week we made a lower low. If we break below 97, then the next support is at 95.75. Folks, this is extremely alarming. While many are cheering the rally in indices, the US dollar is basically negating the whole move, and then some. If rates start going higher again while the dollar keeps falling, that's when you know global investors are questioning the credibility of US debt. That out of the way, let's take a look at the economic calendar for the week ahead. Here is what to watch this week on the macro front. On Monday, we have Chicago PMI. On Tuesday, we have manufacturing PMI, construction spending, job openings, ISM manufacturing, and auto sales. On Wednesday, we have ADP employment report. On Thursday, we have initial jobless claims, employment report, unemployment rate, hourly wages, trade deficit, S&P services PMI, factory orders, and ISM services. On Friday is July 4th and markets are closed for Independence Day. Earnings are light this week, but it's a packed economy calendar, especially Thursday. Labor and inflation data will likely shape how market positions into the next Fed decision. So yes, we're still at all-time highs. Momentum is strong, liquidity is abundant, and big names are still carrying the weight of the market. But context matters. Look, I'm not here to make you worry or scream doom and gloom, but I genuinely believe we're going to get a sharp correction at some point. Maybe it's this year, maybe it's next. The timing doesn't matter as much as the fact that the cracks are already forming. And when it does happen, it will get blamed on one headline. But the signs were there all along. You just had to pay attention. So before you blindly chase this market, stop and ask yourself, what are you really trying to accomplish here? Are you trading the momentum? Are you investing for the long term? Or are you just reacting? Personally, I do both trading and long-term investing. I still find names I like for a long-term portfolio. I've been a big uranium advocate for a while, and after the recent April pullback, I've been adding more. But when it comes to trading, it's all about momentum and sentiment. That's where the edge is right now. This isn't about calling tops or bottoms. It's about staying selective, adaptive, and grounded in what the data is actually telling us, not just the headlines. If this recap helped bring some clarity to the chaos, hit like, subscribe, and don't miss the newsletter. It's where I break all of this down first, share my notes, setups, and insights before the video even goes live. And let me know in the comments, what setups are you watching as we head into July? Thanks for watching, and I will see you in the next one.